Hi everyone, welcome to today's video. So on today's video, I'm going to discuss three very important points with you. First and foremost, are we in a recession or are we inching close to a recession? This is a very important discussion because this can lead to a lot of pain in terms of seeing your portfolio in red. So please understand this point carefully. Second key point, that because of the given volatility in the market right now, should you just sell your portfolio, come back in when everything stabilizes? Should you be doing that or not doing that? And third and finally, there are very, very important points that I will tell you from an investment point of view and one major change that I'm making in my investment strategy right now. So let's get the discussion started, and also a very big shout out to our sponsors for today, which is Golden Pi. It is India's #1 bond investing platform. I have personally used the product and I have invested my parents' money in bonds because they keep on saying that, hey, we need to make like regular income. So please tell us a way to make this regular income, and bond investing is an excellent way to make regular income, so to say. Is it completely safe? The answer is no, it is not completely safe. Please watch my video here. You will get a better understanding. But yes, it is a more reliable option, especially in volatile markets. So let's first and foremost speak about the recession theory. And here is an important piece of data that I would like to share with you. So if you zoom in on this graph, you will see something very, very interesting. What you will see is that this is the unemployment rate in the US. Now, why have I picked the US data? Number one, the US data is very transparent and it's very easy to aggregate. And second is that the US market acts as a proxy for the entire world. Whenever there is recession in the US, the world also faces recession. This is what we have seen over the last 4 or 5 decades. So with that point of view, take a look at these red dots. This is when the internet bubble burst, and here the unemployment rate before the busting of the internet bubble was close to 4%. So it simply means that people who were willing to work were not finding work. How many of them? 4 out of 100. Therefore, the unemployment rate was very, very low before the burst came in. And as the bubble burst and the unemployment rate went up to roughly 6%. Okay, again, so this is the period of 2007-2008. Here again, the unemployment rate was very low. And as the 2008 financial crisis bubble burst, the unemployment rate went skyrocket. It went roughly to 9.5%. What happened in the recent crash? This is roughly end of 2009, which is beginning of 2020. That is when the COVID situation played in. Here, the unemployment rate was at historic low, so to say, roughly 3.67%. The bubble burst and the unemployment rate spiked up to 8.31% at the peak of COVID. So the equation is very simple, that low unemployment rate is equal to impending recession. This has worked out every single time over the last few decades. I'm smiling and speaking about this because this is such a contrarian thought process, and the word of the day today is contrarian. So let me know, what does that mean? Now, psychologically speaking, why do you think that this situation would play out? I will just give you a very quick snippet into this also. So what happens is that if everyone is employed in the economy, then what does that indicate? If everyone is fully employed, everyone who wants a job has a job, it simply means that, you know what, everything is going great in the economy, everyone has money to spend, and they will be fully invested in stock markets and every asset class that they can get their hold on. So this is what is the significance of very high employment rate. That high employment rate simply means everyone is fully fed, so to say, and now only bad things can happen from this point, and that leads to a recession by bursting some kind of bubble. For example, the bubble burst in 2000, in 2008, 2020, so to say, right? And the stock market witnessed a lot of crash. Now you will say, Akshat, okay, great, but why are you speaking so much about unemployment rate and recession? Can you show some latest data? Okay, so this is where the scary parts comes into the picture. Now, this is the monthly unemployment rate. Please remember that if the unemployment rate is going down and down and down month after month, it indicates that there might be a looming recession that might happen. So if you check the latest data of 2022, the unemployment rate is going down. Now, please don't say that, Akshat, last month it was 3.9, now it is 4. So it has increased. Yes, very little. But generally speaking, the trend line is going down for unemployment rate in the US. And therefore, there is so much commentary that is going on in terms of fueling this recession theory. Now you will say, Akshat, can you give a guarantee that recession is 100% going to happen? No one can give a guarantee that recession is going to happen, but I can say the following key very important points. So point 1 is that we are moving towards a sideways market, and there is a very big chance that we will stay for a substantial period of time in a sideways market. This is not me changing my tune. I have said and maintained the viewpoint that The prospects are bullish if you take a 2-3 year viewpoint. There is absolutely no doubt about that. But in the short term, at least for this year, it seems like that we are moving towards a sideways market. I have made several videos and I've covered this concept earlier. So this is not me changing my tune, but just for summary and elucidating this point that mid-term I am bullish, mid to long term I am bullish, but in the short term I have said it multiple times that this year we are likely to witness a sideways moving market. Now you'll say, Akshat, then why are you spreading all this pessimism? I just started investing in the stock market and you're talking about recession, all these bad things. Why is that, right? So can you tell me a little bit more? Okay, so 2-3 things have started happening. First and foremost, you might have seen your portfolio correct. Seeing your portfolio in red is not a happy sight and a lot of investors get panicked. So this is the first key problem that you will see, that whatever investments that you will be making this year, very high chance that even if you are investing in a good company, you might still see those stocks going in red. Why? Because that is the very nature of a sideways moving market. Let me demonstrate that point more by taking you to the Nifty chart. So here what you will see is that post 2008, there was a period, for example, here the market recovery happened and we moved to 4,500 Nifty. And from 2008 to roughly 2014, the stock market did not give much return. Hardly any major return, and a lot of investors lost patience in these 5-6 years. Yes, this was a very long sideways movement. Will it happen this time also? I will make a separate video on that because that will be a slightly more detailed oriented discussion. So probably a separate topic. Let me know if you're interested in me doing that. But the point is that during this phase from 2008 to 2014, the market kept on moving sideways and this was not a pleasant sight for majority of the retail investors. A lot of people lost patience. Then again, if you consider this phase from 2018 to roughly 2019, again, very little returns that Nifty gave. So this is the very nature of the sideways moving market, that if you are investing in a sideways moving market, 2 things might happen. One is you might see your portfolio going in red. And number 2, there will be very dull periods in the market, which will frustrate you. So please keep these 2 points in mind. This brings us to the next phase of the discussion that, okay, Akshat, then should I just leave the market, let this sideways market stop, and then like a genius, I'll jump into the market again and I will invest on 15th December and from 16th December, the run up will start happening. So should I be doing that? And tell me the date also when this sideways moving market will end. Now, I can't tell you the date. No investor in the world can tell you the date as to when this sideways moving market will end. No one, absolutely no one can guarantee that. So then what is the best course of action? So I will say 2 things. So number 1, please stay invested in the market. Please don't stop your SIPs. Please don't move away from the market. Please don't wait for the volatility to end. Why is that? This is the second key point. That whenever the up run happens in the market, it happens very, very violently and you will not be able to catch it. You will not even realize when the markets are going up. You will miss that investment buzz and you will feel super frustrated with it. This is primarily the reason almost every big investor still keeps 80% of their portfolio in the market itself. They don't withdraw it and keep the money under their bed. Why is that? Now, can I give you some data to prove this hypothesis that you should stay invested in the market? So the answer is yes. I can show you some macro data as well. So if you study the history of bull and bear run in the US market, you will observe that this was a period when bear run happened, right? The market crashed, then it went up. Then market crashed, went up, market crashed, went up, market crashed, went up, market crashed, went up, so on and so forth. So you will see that bull run happens roughly 70-80% of the time and bear run happens roughly 20% of the time. So just because you want to avoid that 20% time, you don't have the habit of seeing your portfolio in red, therefore I'll pull out money and wait for the bull run to happen. Please don't do that, because 50% of bull run might happen and then you will get the confidence that, okay, now you know what, bull run has started, now I will start investing. Please don't do that. No one can time the market. This is an excellent quote from Peter Lynch and I'm paraphrasing that people have lost more money just waiting for the stock market correction to get over rather than losing the money in the correction itself. So please remember this quote. This is a very, very important quote. So from this discussion, the natural question would be that, okay, then what is it that I should be doing versus not doing? Now, these are my personal opinions. Please do your further due diligence on it, but I will leave you with 3 very important points. Number 1, please focus on asset allocation. Now, what does that mean? That there are different types of assets. For example, there is debt, there is equity, there is cryptos, there is real estate. So please spread out your investment. Please do not be 100% in equity in a shrinking market or a sideways market. I have made so many videos where I've categorically said that a certain portion of my portfolio is dedicated to cryptos. A certain portion of my portfolio is dedicated to real estate, commercial real estate only, and majorly I am an equity investor. Now, I can't tell you that, hey, have like 30% in debt or 50% in equity. Please figure out the mix that makes sense for you. But asset allocation becomes really important during a sideways moving market, because if you are making negative returns or zero returns from your equity portfolio, at least from other asset classes, you should be making some returns. This is point number one. And this is the precise discussion that I was having with my parents last night, because they need regular income from their investment. From that perspective, I advise my parents to put more money in debt, and I invested via the Golden Pie platform. Again, you can go and check it. I have personally used it and have loved the experience. In case you want where I have invested my parents' money in debt, just comment below. I will make a separate video on that topic. Number two, the index funds, you need to be very, very careful right now in terms of investing. Why? Again, let me take you to the Nifty chart. For example, if you would have invested roughly 6,000 rupees in 2010, till 2014, it would not have given you any returns. This is the problem with index investing, that it sounds really fancy, really nice, and it's good for beginners. I'm not at all against index investing, but in a sideways market, index investing gives really, really bad return. So you need to be very careful as to do more or less of index investing. My viewpoint will be that you should not do too much of index investing in a sideways moving market. So at least not put new money into index fund. Now comes the third and the most important point, that here the quality of asset that you own becomes crucial. It becomes absolutely critical that what type of assets you are owning. If you are owning hyperinflated stocks and they have not fallen yet, then they are likely to show the most correction. So please sell them off, move on to slightly more safer stocks. What are safer stocks? What are risky stocks? I have made some videos. Again, let me know. I will make a separate video on that. But just to build up on that point and wrapping up the conversation, that please invest in companies that are making sensible cash flows, that are making profits. Please do not bet your money on story-based stocks that, profits will come 10 years from now. Till then, please keep on betting on us. Please avoid these type of stocks. These stocks have been gutted. I have made several videos on IPO investing, and almost 9 out of 10 IPOs, I said no, right? And when the markets were super bullish, people were super happy that, hey, I made like X% gain, Y% gain, all that stuff. But now look at the situation. Almost every major company that has launched IPOs, their stock price is down, not just down, down by a lot. Why? Because these are story-based stocks. These are not cash flow stocks that are giving real profits. So please apply these techniques. Let me know how did you find this video. Please give it a thumbs up, and I will see you tomorrow.